We start with the continuing turmoil in the financial markets.
I don't want anything to go down.
Already plunging, extending a slide that has wiped out nearly $6 trillion from the S&P 500 index in
The global economy is on edge. Markets are crashing, inflation is biting harder than ever, and President Trump's new tariffs have just thrown international trade into chaos. So, what does it mean for your money? And more importantly, what can you do about it now? My name is Raphael. I'm a commercial lawyer and a commercial advisor. And on this channel, I break down complex money topics so you can take control of your finances and thrive even in uncertain times like these. In today's video, we're diving deep into what's really happening in the economy right now, how inflation, tariffs, and a crashing market affects your everyday life. I'm going to talk about what you should be investing in, what you should be avoiding, and practical steps that you can take to protect and grow your wealth in 2025. Let's start with the current economic environment. In many countries, including Australia, the US, and parts of Europe, inflation remains stubbornly high. Although central banks have paused rates, the fact of the matter is core inflation on essential items like groceries, rents, utilities, and fuel have not come down meaningfully. And despite economic data suggesting price increases are stabilizing, the lived reality for most people, including myself, is that everything still feels expensive.
Good afternoon. We're coming on the air for a moment here. The closing bell on Wall Street ending what has been a very tumultuous 2 days for the stock market. Another day of steep losses here.
In the last week, we saw global stock markets take a serious hit. The Dow Jones Industrial Average dropped more than 2,000 points in a single day. The Nasdaq entered bear market territory, and investor confidence has been severely shaken. And even major tech stocks, which are usually seen as a relatively safe bet, have seen dramatic losses. Now, this is a major correction that has rattled both retail and institutional investors. Now, much of the volatility has been triggered by sweeping new policy from President Trump, in which he has called Liberation Day, in which he implemented a 10% universal tariff on all imports to the United States.
We're going to charge them 46% tariff.
Now, some countries such as China, Japan, South Korea, and the European Union, they're facing even a higher tariff of 20 to 34%. And these tariffs are part of a broader push to reinvigorate domestic manufacturing. But the fact of the matter is, critics argue that they could severely damage global trade, increase costs for American consumers, and quite frankly, provoke retaliation. And retaliation has already begun. China has responded with a 34% tariff on all US goods, and European leaders have condemned the move, and trade talks between several major economies have stalled. So we're already seeing major changes happening, including to supply chains, which are being disrupted. And this is creating a ripple effect across global markets, including Australia, where imported goods and fuel costs are expected to rise significantly. So what does it mean for your wallet? First, I'm sorry to say, but expect the cost of living to rise again. If you think groceries and rent and basic services are already expensive, get ready to tighten your belt even more. Many imported consumer goods, from electronics to cars to clothing, well, they're going to be pricier as tariffs are passed onto consumers. And for those of you who are planning on major purchases, this might be the time to reconsider or act fast before prices go even higher. In fact, I hate to say it, but you might have already been, well, you might be out of luck already. Because, Land Rover, for example, they decided to pause shipments because they need to assess the tariffs, which realistically means that they are trying to price in the tariffs to pass on to the consumer. Now, housing, that remains another major issue. In Australia and other developed countries, property prices remain high despite interest rate pressures, and affordability has worsened for younger people and first-time home buyers. And delay in home ownership are causing major knock-on effects, especially for family planning, investment behavior, and quite frankly, just overall wealth creation. And wages, well, they're not keeping pace with inflation. They've also really haven't kept pace with historic increases in house prices, but let's just talk about that in another video. If we go back to inflation, wage growth may be hovering around 3 to 4% in some countries, but inflation has already eroded real earnings. Households, they feel like they're working harder than ever, but they're still falling behind. And at the same time, investment portfolios have taken a hit, leaving many to wonder where to turn to. Now, with everything that I've just said, I want you to all come around in a circle. Let's huddle. Let's talk strategy. Now, first and foremost, don't panic. Economic downturns can be dangerous if you make rush decisions, but they can also present massive opportunities for those who stay informed and disciplined. Now, one proven investment strategy right now is dollar cost averaging. This means investing small amounts of money regularly, whether the markets are up or down. And over time, this allows you to buy more shares when prices are low and fewer when they're high, helping smooth out volatility in the long term. To do this, look into diversified ETFs and broad index funds, such as VTI or SPY in the US, or the A200 or the VAS in Australia. Now, I'm not giving investment advice at all. What I'm showing you is examples of ETFs and index funds. And these are investment vehicles which are designed to track large parts of the market so you can reduce your exposure to individual stock risk. So for example, VTI, that gives you exposure to the entire US stock market, which includes large cap, mid cap, small cap, and micro cap stocks. This means it holds over 4,000 US companies. If you are in another country, you will find exchange traded funds and index funds in your own domestic market. And if everything that I just said was a complete blur, let me know down in the comment section below so I can make a video on what an ETF is and what an index fund is. Next, consider defensive stocks and sectors. In volatile markets, companies in sectors such as healthcare, consumer staples, and utilities, they tend to perform better because people continue to spend money on those necessities regardless of the economic conditions. Now, stocks with consistent cash flow, low debt, and solid dividends should be prioritized highly. Speaking of dividends paying stocks can offer stability and income during market downturns, and reinvesting dividends can also enhance compounding over time. Another example worth exploring is precious metals. Now, gold and silver, they traditionally perform very well in times of high uncertainty, and many investors are turning to these assets to hedge against market chaos and currency devaluation. Now, as I always say, nothing is truly safe. For example, if you look at gold prices now, they have fallen. And in my opinion, however, I feel that a lot of institutional investors have sold off portions of their gold reserves to cover short-term losses in their equity portfolio. And there's still currently uncertainty in the market, especially with upcoming elections around the world and geopolitical factors. So we're going to have to see what happens, but at least historically, when times are tough, people turn to gold. Given new tariffs, now might be the right time to stock up on essentials. So electronics, power tools, car parts, and other imported goods, they're likely to become more expensive in the coming months. So buying now, if you're already planning to, could save you a lot of money. On the other hand, large discretionary purchases such as vehicles and imported furniture might be best delayed if you're uncertain about future costs. So take this opportunity to revisit your budget. Cut out non-essential expenses, cut out those unused subscriptions. I talked about this on my channel before. Switch to cheaper providers and avoid impulse buying, because every dollar saved today can be invested into tomorrow's opportunities. And if you're using a credit card more often due to inflation, consider switching to cards that offer cashback rewards or low interest rates to ease the burden. And where possible, support local businesses and buy local products. This reduces your exposure to volatile global prices and supports your domestic economy. Additionally, this is a great time to diversify your income. Don't rely on one paycheck, whether it's freelancing, side hustling, selling products online, or creating content. Multiple income streams can provide a safety net in tough times. Finally, I've said this so many times, but build an emergency fund of at least 3 to 6 months worth of expenses and keep this in a high interest savings account or an offset account if you have a mortgage. Having this cushion allows you to make smart, unemotional decisions when times get tough. So no matter which way we look at it, we're facing a period of economic turbulence. But this isn't the first time and it won't be the last. So with the right mindset, smart strategies, and a proactive approach, you can not only protect your finances, but you also can put yourself in a position for long-term success. So stay focused, stay flexible, and most importantly, stay informed. Now, if you found this video helpful, I need you to help me. in 2025, I want to grow this channel and help everyone I can. So you can help me by liking, subscribing, and turning the notification bell on. I also want you to leave a comment with your best financial challenge right now. Let's work together and maybe I can help. So thank you again, and I'll see you on the next video.